Welcome to the deep dive. Today, we're jumping right into one of the wildest fintech stories lately, Klarna's massive comeback. I mean, this is the buy now, pay later pioneer, right?
Absolutely. And what a ride it's been.
You probably remember the headlines. Peak pandemic tech boom. They hit this incredible $45 billion valuation in 2021.
Just astronomical. Seemed unstoppable.
And then boom. The 2022 tech sell-off just hammered them. Valuation crashed. What was it, down to $6 billion?
That's right, a staggering drop. Led to layoffs, lots of questions about their survival, frankly.
But here we are looking at 2024, 2025, and it's a totally different picture.
Completely. They've hit profitability, they've really broadened what they offer, and just capped it off with a huge IPO on the New York Stock Exchange.
So it's a story of resilience, maybe reinvention?
Definitely both. A real case study in turning things around.
Okay, let's unpack that transformation. What is Klarna today? It's clearly way more than just that original short-term BNPL thing, looking at what they offer consumers. Sure, pay later, the interest-free short bursts, that's still there, it's core.
Still fundamental, yeah.
But they've layered on quite a bit. There's this fair financing now.
Right, that's for bigger ticket items. Think 6 to 12-month loans, more structured.
And they've got actual cards, too, a Klarna card, a Visa debit.
Yep, pushing into daily payments. And in some markets, like Sweden and Germany, they have savings accounts, take deposits. They operate much more like a bank there.
So for the user, it's about flexibility, managing cash flow, that kind of thing.
That's the consumer pitch,
Okay.
Absolutely. But for understanding the business, the real story, you have to look at the merchants.
Right, because that's where the money's made.
Exactly. They charge fees to, get this, 790,000 merchants globally. Big names, Walmart, eBay, H&M, Nike.
And those guys pay because Klarna helps them sell more.
Precisely. It demonstrably boosts conversion rates, increases the average order value. So merchants see a clear return. That's the engine.
The scale definitely backs that up. How many users now? It's over 100 million, right?
111 million active users. That's a big jump, up from 93 million at the end of FY 2024.
Wow. 18 million in, what, a year or so?
Yeah, significant growth. And look at the gross merchandise volume, the total value of stuff people buy using Klarna.
What was that for 2024?
$105 billion for the full year.
Yeah.
And Q2 of 2025 just came in at $31.2 billion.
Which is up quite a bit year over year.
Up 19% like for like. Strong momentum.
So putting it all together, they've really shifted. Not just a niche credit app anymore.
Not at all. It's a global commerce platform, almost a hybrid banking platform now.
Okay, that sets the stage for the big event, the IPO, in September 2025. This really got people talking. Tell us about the launch. Pricing, first day.
Right. This was highly anticipated. It priced at $40 a share, which was actually above the range they initially guided.
Right.
Signaled strong demand.
And the first day of trading.
Pretty explosive. Opened at $52.
Wow, quite a pop from the $40 price.
Yeah, and it even touched $57.20 during the day before settling back a bit. Closed the first day at $45.82.
So doing the math, still a 15% gain on the day, with highs near 30%.
Exactly. A very solid debut, all things considered.
What did that put the valuation at?
Right around $17 billion on debut. And they raised $1.37 billion in the offering.
But hang on, wasn't most of that existing investors selling, not the company raising new cash?
That's a crucial point. Klarna itself only issued about 5 million new shares. Most of the shares sold were from early backers taking some money off the table.
Speaking of backers, winners and losers here. Sequoia must be happy. They got in super early back in 2009.
Oh, absolutely. Sequoia made out very well. But then you have SoftBank's Vision Fund.
Ah, yes. They piled in during the hype, right? At those $30, $45 billion valuations in 2021.
It did. And at $17 billion, they're still significantly underwater on that investment for now. It highlights the volatility.
So big picture on the IPO. It's a success, puts Klarna back in the spotlight, maybe signals the IPO market is warming up again.
Definitely a symbol of a reviving market after a few dry years.
Yeah.
But it also anchors Klarna at this, $17 billion mark. Much more realistic than $45 billion, but a huge recovery from that $6 billion low point.
Okay, but an IPO like that needs solid financials underneath. What were the numbers that gave investors confidence? Let's look at the full year 2024 results first. That seems like the turning point.
It really was. FY 2024, they showed net operating income hitting SEK 25.4 billion. That's up about 25%.
And the big one, profit.
Yes, crucially, their first profit in years. An operating profit of SEK 0.3 billion. Compare that to a loss of SEK 3.3 billion, roughly $300 million US the year before.
Huge swing. And net profit?
Net profit came in at SEK 0.14 billion. Small, but positive. That was the narrative shift they desperately needed.
And that momentum continued into 2025.
It did. Q2 2025 figures showed revenue at $823 million, up 20% year over year. And importantly, adjusted operating profit was $29 million.
Okay, $29 million profit. And that was their fifth straight profitable quarter.
Fifth straight. Consistency is key when you're going public.
Right, but let's pause on that. $29 million profit on $823 million revenue. I mean, the margins aren't enormous for a $17 billion company. Is this sustainable scale or just hitting the numbers for the IPO?
That's the fair question. And the answer seems to lie in efficiency gains. Their trailing 12-month revenue is around $3 billion now.
Okay.
But look at this metric. Average revenue per employee hit $1.0 million.
$1 million per employee? That's huge. That's like big tech territory, not usually lending.
Exactly. And they credit a massive part of that leap to really aggressive AI adoption. Customer service, risk management, operations. AI is embedded everywhere.
So that AI efficiency is underpinning the profitability story, even if the absolute profit number seems modest for the valuation.
That seems to be the argument. That consistent move from big losses to operational profit, driven by efficiency, was the ticket to the IPO.
And they shored up the balance sheet, too. More bank-like.
Very much so. Their capital ratios are strong. CET1 is 16.8%, total capital ratio 21.4%, both well above the regulatory minimums. They look much less like a risky startup now.
Okay, which brings us neatly to credit quality. That's always the Achilles heel for lenders, right? Especially as they move into riskier products like fair financing term loans. What did the delinquency numbers show?
Well, on the core pay later product, the short-term stuff, delinquencies are actually down. 60-plus day delinquency is at 0.89%, improved from 1.03% a year ago.
That's good news. What about the longer-term fair financing loans?
Those are higher, as you'd expect. Delinquency there is around 2.2%. Still, that's generally below what you see on typical credit card portfolios.
And overall losses?
Realized losses, actual write-offs are running about 0.45% of the total gross merchandise volume. Seems manageable.
But I saw provisions went up. The money set aside for future losses.
Ah, yes, that's the interesting wrinkle. Provisions rose to 0.56% of GMV, up from 0.42%.
So losses are stable, but they're expecting more trouble ahead. What's driving that?
It's not necessarily predicting a consumer meltdown. There are two main drivers. First, the big push into the U.S. market.
Which is riskier than Europe.
Generally seen as higher risk, yes, but also offers higher potential fees. So they have to provision more heavily for U.S. growth.
Okay, that makes sense. What's the second reason?
It's an accounting thing tied to fair financing. Because those are longer loans, accounting rules require them to book the entire expected loss provision up front the day the loan is made.
Even though the revenue comes in over 6 or 12 months.
Exactly. So it creates this timing mismatch where provisions look higher now, even if the actual realized losses down the road remain stable. It inflates the provision number temporarily.
Got it. So headline provisions look a bit worse, but the underlying credit quality seems okay, maybe even improving slightly. The rise is more about strategy, U.S. growth, and term loans and accounting rules.
That appears to be the case, yes.
Let's shift to funding then. How are they paying for all these loans? Especially after those tough equity rounds in 2021, 2022 when their valuation tanked. Raising equity got really expensive.
Right. They couldn't keep relying on venture capital, so they fundamentally shifted their model. It looks much more like a bank now.
How so?
They're funding their loan book about, SEK 94 billion, maybe 8.5 billion US, primarily with consumer deposits.
People are putting savings into Klarna?
Yes, quite a lot. Deposits have grown rapidly, hitting SEK 106.8 billion, which is over $14 billion US by mid-2025.
So they're using cheap deposit funding instead of expensive equity. That's a huge change.
Massive. And it's not just deposits. They diversify their funding, too. They use things like forward flow agreements. Basically, deals where they originate loans and then sell them off their balance sheet to other institutions. They have about $26 billion in capacity for that in the U.S. and U.K. Reduces their own risk.
Okay, so deposits, selling loans, anything else?
Yeah, they have a $1.6 billion warehouse facility, short-term borrowing against loans, and they've started issuing their own bonds, about $157 million worth so far in 2025. It's a much more sophisticated, diversified funding base.
And strategy-wise, they've streamlined. I heard they sold off Klarna checkout.
They did. Divested KCO in 2024. The idea was to focus purely on the payment and lending services, not the full checkout infrastructure for merchants.
You also bought a company, Sifor.
Yes, so for GmbH. They integrated that into Klarna Bank to get better control over payment processing rails within the EU.
all these changes, the funding, the structure, the focus, it ties into those big partnerships, right? Walmart, eBay.
Absolutely. Becoming the exclusive BNPL provider for Walmart in the U.S. is enormous. Partnering with eBay, integrating with Stripe, Nexi, WorldPay, JP Morgan Payments, it gives them massive distribution reach without needing their own huge sales force targeting every single merchant.
So it really does look like a different beast now, a scaled bank fintech hybrid, not just a startup.
That's a good way to put it. Much more mature, more diversified.
But maturity brings scrutiny. No fintech story is complete without talking regulations and risks. What are the big ones facing Klarna now?
Well, compliance is definitely a major one. They got hit with a fairly large fine in Sweden, SEK 500 million.
What was that for?
Anti-money laundering and know your customer rules. AML KYC shortcomings. Importantly, the report said no actual fraud was found, but it shows regulators are holding them to bank-level standards now. No more startup shortcuts.
And that regulatory pressure is global, isn't it? BNPL is under the microscope everywhere.
Everywhere. In the U.S., the CFPB, with the Consumer Financial Protection Bureau, is actively working on rules to make BNPL providers more like credit card companies.
What would that mean? More capital requirements? Stricter underwriting?
Potentially both. If they have to follow all the same rules as traditional credit cards, especially around things like capital reserves and dispute resolution, it could really impact the economics of their core short-term BNPL product.
In Europe.
Similar story. The EU and the UK are both updating their consumer credit rules. The Consumer Credit Directive, PSD3, it means Klarna faces this complex patchwork of evolving and likely stricter regulations across all its key markets.
That sounds expensive and complicated to manage.
It is. Significant operational cost and complexity. Add to that other risks. Their heavy reliance on those AI systems working flawlessly. Cybersecurity threats are always there. And then there's just the sheer challenge of global compliance.
And of course, the valuation risk we touched on. $17 billion still requires a lot of growth and profitability to justify it.
Precisely. It's priced for significant future success. So the key question for investors is this rally just IPO momentum and comeback excitement? Or is the underlying business strong enough to power through these regulatory headwinds and potential credit cycle shifts?
Okay, that brings us to the final wrap-up. For someone looking at Klarna now, post-IPO, what's the bull case? Why jump in?
The bull case is pretty straightforward, I think. They survived a near-death experience, proved they could pivot, achieve profitability, and completely revamp their funding to be more stable and bank-like.
Plus, the partnerships give them a moat.
Huge moat.
Yeah.
Walmart, eBay. That's massive validation and distribution. And the IPO itself restores credibility, gives them public currency for maybe future acquisitions or just continued growth.
Yeah.
It's a turnaround story that seems to have worked.
Okay, compelling. Now, the flip side, the bear case. Why stay away or be cautious?
The caution comes from a few areas. Those rising credit provisions, while explainable partly by strategy and accounting, still signal potential stress, especially from the U.S. expansion and longer-term loans. You have to watch that closely.
And regulation.
Regulation is the big unknown. It's intensifying everywhere, and new rules could fundamentally change the profitability of their core business. That's a major overhang.
On the evaluation.
And the valuation, yes. $17 billion demands near-perfect execution. They need to keep delivering quarter after quarter on that high-efficiency, AI-driven model to justify the price tag, especially with potentially higher compliance costs coming.
So it really feels like the start of Act 2 for Klarna. From the $45 billion peak, the $6 billion crash, now the $17 billion rebirth.
Exactly. It's a whole new chapter. And the decision for anyone watching is, do you bet on this comeback continuing? Or do you wait for more proof on how they handle the next set of challenges, regulation, and the credit cycle?
It's a fascinating case study in how a fintech can adapt under extreme pressure, especially that shift in funding.
It really is. And maybe the final thought for you listening is this. We talked a lot about that AI-driven efficiency, the $1 million revenue per employee. How much of a shield can that really be? Can that level of efficiency truly insulate Klarna enough from potentially rising credit losses and the definite increase in regulatory costs? That's the tension to watch.
Just a reminder to everyone listening, we are not certified financial advisors, and this content is only for educational purposes.
That's right. If you are considering making any investment decisions, please make sure you consult with a certified financial advisor.